wanted to go over Chapter 2 today. I wanted to go over Chapter 2, Consolidation of Financial Information, Intro to Business Combinations. So what I wanted to go over is a couple of things today with the lecture. So I'm going to do about a 30-minute lecture right now. Then I prepared a small example for you guys to do. So I want you guys to work in pairs to work something out, okay? And then we're going to finish to do another 30-minute study. And when you guys do, I'm not going to do this officially in this class. Usually in past classes I've done this where 3-4 people work in a group, all class, and they have each other's email, and there's an email chain. I'm not going to do that here. I'm going to do it a little bit differently. But I do want you guys to take each other's email down. I know some of you guys sit together with a friend already, and I'm sure you guys study together as well. But for people who sort of, I don't mind pairing you guys up if that's what would be helpful. But sort of take each other's email down. So if you miss class or you're going to study for the exam or you're going to do the homework, I'd like for you guys to work together. It's not something that I'm going to manage personally, but in class I could facilitate that. Because I find that these problems are just too complicated to do by yourself, in a way. You'll get a chance to do it by yourself on the exam, of course. But for now, just from personal experience of doing a lot of technical business work, is that it's better to do with somebody who already knows it, or you're going to work it out together, than figuring it all out. It's just less time consuming and more fun, no? All right, so I'll do that later. So for the exercise, I'll pair you guys up if you haven't paired up yet, and consider that your case study group. Your case study group. And also, I don't know if you saw, I don't know if it's even this section, but I started designing the case study that we're going to do in mid-October. I posted it on one of the sections already, and it's going to be about fuel hedging. And that's definitely going to be a team project, and I do want to see presentations for that. Probably not everybody will present, but I am going to select like a couple of teams to present, like an actual presentation. So for that, also, leverage that person that you team up with today. Have their email, okay? So that you have that extra support each other, and use that help to learn. So today, what is the acquisition? So we're going to talk about the acquisition method today, the consolidation method today. And what I wanted to start with is in Chapter 2, page 42, guys. It's going to be helpful from now on to bring the actual book to class, the packet or the book, because I'm going to start getting into like detailed exhibits like this over here. So it's good to have. If you don't have today, it's okay too. Share with a partner. But what I wanted to do is go over Microsoft and Skype, just to use the example in the book that says here on October 13th, 2011, Microsoft acquired all the outstanding shares of the internet phone company Skype Global, internet communications company founded in 2003, based in Luxembourg, costing $8.5 billion. The Skype deal is the biggest in 37-year history of Microsoft and expands Microsoft's presence beyond Windows and Office software products. Blah, 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 blah. And it says that in the past, Skype was owned by eBay that bought it for $3.1 billion in 2005 and then sold its ownership to a private equity group in 2009. Okay? Skype has earned little in profits and posted a net loss of $7 million of revenues of $860 million. So, what's the goodwill, guys, on this acquisition? We're saying that the company had a net loss of $7 million and revenues of $860 million. We don't really see the balance sheet. We don't really see the balance sheet of Skype. This is not Skype. But the idea is the company is showing a loss, really, right? So the company is showing a loss. The revenue doesn't really substantiate that kind of price tag, right? So clearly, they're paying $8.5 billion is a lot. And what else is interesting about this situation, guys? The history of Skype. in terms of what we did on the board last time, the whole class. Who were the people who were transacting in Skype? eBay, private equity firm, and Microsoft. Kind of exactly like what we had on the board in terms of the players, right? A lateral player, eBay, that doesn't really do any kind of phone communication, probably owns Skype just because they had nothing better to do with their money, because they have a lot of cash. Because they don't do any of that. They were just, oh, that's a great asset. Let's see if we can do something with it, right? Private equity, then sold it to private equity. What did private equity do with it? They're just like, we just want to financial engineer it into more money. And they did it because, what did they buy it for? 3.1 and sold it for 8.5. So private equity in 5 years did well for themselves. Made $5.5 billion, it looks like. Right? And now what's Microsoft doing? Very strategic, no? Because Microsoft is the desktop in Windows. And Skype is the mode of communication and video on desktop or Mac. But nonetheless, very strategic because now you are in every single computer, basically. And that's what Microsoft wants. They want to be on a computer, any kind of computer, so they can be like, oh, you have Skype, well, download this other mobile, blah, blah, blah. We're going to offer more products. So it's strategic. So, and you could see, okay, and then they're saying, nonetheless, the high expectations for synergies across Microsoft and Skype are evidenced by the $7.1 billion goodwill attributed to the acquisition, as noted in Microsoft's 2012 SEC Form 10-K. The goodwill recognized in connection with the acquisition is primarily attributable to our expectations of extending Skype's brand and reach of its network platform, while enhancing Microsoft's existing portfolio of real-time communication products and services. So the idea is to basically get into any device that Skype is on and deploy more software there, right? Because Microsoft is really good with software, right? I personally don't know what they do with mobile software. Does anybody know what do they do with mobile? Didn't they buy Nokia? I mean, it makes sense. It makes sense because Nokia was the biggest cell phone maker about 6, 7, 8 years ago, 9 years ago. When I first got a cell phone, I remember Nokia was the most popular phone back then. If you remember. But then they forgot to keep going. But the idea is, yeah, it's interesting how much goodwill this transaction has is about $7.1 billion of goodwill, right? So with a price tag of $8.5 billion, what do you think were the net assets of Skype? So if we have $8.5 billion payment, right, that's how much we paid, and $7.1 billion was the excess over book value. What was the book value? $1.4 billion, right? 1.4 billion is the book value of Skype. What does that mean? What does that mean? If you looked on the balance sheet of Skype, what would you see? There's some numbers you could already get there. Yeah. Yeah, exactly. So you already know if you looked on the Skype balance sheet that the assets minus the liabilities is 1.4. In other words, this is how much real assets they have, which means assets less liabilities. Assets less what you owe is 1.4 billion. Right? And everything else is excess goodwill. Right? Good. Skype? Yeah. Definitely famous. Very good brand. First mover advantage, yeah. So now, that we have that start to get us going, what I wanted to go over is essentially the acquisition method and what's going on when two companies are combining each other, when they're consolidating and bringing their books together. Like, what are we doing? Like, before we looked at the equity method, when you come in with 30% ownership, right? Now, what happens if you have 100% ownership that you're getting of a company? Like, what's the situation? So the first idea we're going to go through is, how do you consolidate? And the way I would look, say this example has Calico here as a company that's balance sheet right here, and we have Malibu Co. that has a balance sheet right here. So the idea with consolidation, if the solution takes place, it's a one journal entry type thing, because you had a company, say, coming in, buys another company, and it just dissolves the other company. So the goal in the transaction is just to put the new assets on your balance sheet. So do you put the assets on your balance sheet if you're Calico and you're buying this Malibu? Do you put them at fair value or book value? Fair value, right? So essentially your job is just to do this. Is just to match up your assets, right? To just match up your assets, grab these assets, put them on your balance sheet, and what else? What else do you need to record? You could be a liability, right? Because you need to pay for these assets, right? So in this situation, what's going on? How much is this costing you? Say there's no goodwill whatsoever. How much is this little purchase going to cost you? What's going to be your bill for Malibu? Well, great, yeah, 1.4. That's the bill that's what they want. No goodwill, fair value. You pay the fair value, easy. So 1.4 million. You cut the check, right? But what if you don't have 1.4 million, right? So the idea is you need to finance the 1.4 million. And there's 3 different ways to finance a transaction. I think we talked a little bit about this side. There was not a lot of room left here last time. But the financing side, is a different side, but it's like, how do you come up with the money, right? And we talked a little bit. So what are the different 3 ways usually companies use to finance a potential acquisition or a real acquisition? Over here. Issue stock, private investors, sell assets, yeah, that's it. What about anything to add? Bonds, right? You only said stock, so bonds and cash is the other 2. So it's equity, bonds, and cash. And selling off assets, I like that, so that's good, right? Long-term debt. Right, basically notes payable also. Like, you could have in the bonds area, there's the 3 types. There's the line of credit, short-term notes, or long-term debt. So a lot of people have different types of financing there. So that's the financing piece. They'll get that money, they'll get that money, and then they'll pay the money to Malibu Co., and they'll bring over the assets from Malibu Co. over to Cali. So there's going to be a mix in terms of payment. There's going to be a mix between cash and equity. So the goal, guys, I just want to go over the goal with you guys of this chapter. There's a certain twist, because the way I teach it, I think it ends up sounding pretty easy. But then the idea is that there's a twist to this on page 57. There's this, it's called a worksheet. This thing is called a worksheet. And we're gonna be looking at these throughout the next 3 weeks, the worksheets. I'm still trying to figure out what they're talking in this worksheet about exactly. But the idea is I put it over here, because what we want to understand in terms of consolidation and elimination of these entries, right? I just want to give you guys the goal and maybe open it up or share it with your neighbor also and start bringing this piece to class, is that we want to understand on the journal level what's happening with the elimination entries. The way I explain it and the way I see it is more on the actual experiential level. That's how I understand it. But sometimes you'll look at a big worksheet and you may know and understand what's going on a transaction like this, but you also have to understand the worksheet. So I want to work with that a little bit later. And the worksheet is basically a byproduct of a couple of these journal entries. So first I want to nail down the 3 types of journal entries that you can have in this universe of acquisition. And then I want to apply those journal entries and drop them into the worksheet so you could see how you go from having essentially 2 companies into 1 company, and the type of journal entries that correct all the issues that occur throughout the year at the end of the year. Okay? So, Calico acquires Malibu Inc. and agrees to pay $1.4 billion for Malibu Inc.'s assets and liabilities. The payment for this consideration is in the form of $500,000 of cash and $900,000 of equity, right? So, how many shares of equity do we issue? What do you guys think? 20,000, exactly. Great. And what was the price per share? No. 45. 45. Yeah. Right? Because we have 200. We issued 200, right? How did she know right away? Very quickly. She knew that it was 20,000 divided by 10 right away, right? I don't know how you knew that quickly that it was 45. Then we found that. Oh, there we go. Oh, we did. We went over this before. I had like 3 classes. I thought we didn't yet. So the idea is that we have 45, so we issue those shares, and why do we credit, for example, why do we credit cash, credit equity? Whose books are we in? And the acquirer, in terms of debiting the assets, they're debiting the assets because now they have the assets, right? They credit equity because they issued the equity, right? And they credit cash because the cash is leaving their account. Makes sense so far, right? So this is pretty much the idea of how you go through this type of transaction. And then the other scenario is if we're paying more, then if we're paying less, for example, in which case do we record the excess bargain purchase? Like, what does this piece represent? So we paid less than the fair value. So we have an imbalance between the amount of assets that we're getting and the amount of consideration that we're providing. And the imbalance is basically results in a gain. Right? And now we have the idea that we're paying more. We're paying $1.6 million. And now we have cash, stock, additional paid-in capital, and we have an excess situation where we need more asset, and that asset is goodwill. So far, so good, right? Okay. Now, the other side of this that I wanted to go over is in terms of paying accounting and legal fees. If you have any kind of accounting and legal fees while you're acquiring a company, all you're going to do is debit expense, credit cash. It's just another expense. There's no trick to it. Now, if you're going to issue stock and you register that stock with the SEC and that costs you $20,000, this is something that is going to be net of the stock issuance. So if you issued stock, in reality, you issued 920 in stock, and we had 900,000 left. That's what's left, because this expense gets netted from the proceeds. So that's the trick. You know, a lot of questions will come around this and be like, oh, I'm trying to ask you what's happened with this one. That's just an expense. This one is a reduction of equity from the proceed. So before we get there, I want to go over the other slides here. But before we get there, I want you guys to work in your pairs, and I'll walk around for that, in your pairs, to go over this example here. And this is a situation, say, I just put down here before class, a situation, say, Microsoft acquires Apple, and the Apple legal status is dissolved. Now, this is the book value of the Apple assets, their fair value, right? And this is the Microsoft balance sheet here. So we're acquiring that. So Microsoft acquires that. And then the three scenarios is paying 833, 1.2, and 600, all in millions. And I want you guys to book these three journal entries. Just write them out. Work on it with your partner. I'll walk around and help you. Write out the three scenarios. I want you guys to kind of really nail that, because I want to get into this worksheet and really get an understanding of the worksheet next. So we need to know, what is the asset journal entry? What is the equity journal entry? You know, before you guys start, just 1 minute on the asset and the equity journal entry that's in the book. When you go over in the book and we talk about A journal entry or S journal entry, right? This is elimination journal entries in the worksheet, right? And I want you guys to get familiar. It's a little bit of a lingo. It's almost like a little bit of a programming language, kind of like. It's very AIS-like, huh? So the idea is that it's A is for assets. So A is the markup assets. So in other words, if I have an A journal entry for assets, what I'm looking to do is mark up assets. I'm like, listen, some of these assets have a higher fair value than book value, so I'm going to bring that over in terms of consolidating the two companies. And what's the equity journal entry? The equity journal entry is the elimination of the equity of the subsidiary, right? Because it doesn't really exist anymore, right? And the recording of the initial book value investment. So this is the part that I want to sort of go into a couple of times. I'll probably teach this 3-4 times, because this requires, I think, personally, to get this, you really have to know pretty intimate knowledge of financial statements. And memorization here is, you can try, but it's not easy. So, yeah.
Are we only using this worksheet when it's not, like, the other company's not being dissolved, they're just consolidating?
That's exactly right. That's exactly right. This is the second piece of it, is when we don't dissolve. So this is sort of an example that you see how to bring the assets over. And then when we don't dissolve, you basically do the same thing. But I want to sort of do the easy one first, and then we'll do the second one. It's all it is marking up the assets to fair value on the left side. And on the right side, crediting cash and equity to equal the amount of the assets. So it makes sense, because what you're getting is equal to what you're paying, right? And there's a small twist with the equity, a little par value, additional paid-in capital. If you want to put a finishing touch on it, how many shares were issued, using the current stock price. So that way you're connecting a little bit to the finance, keeping it a little current, to be like, oh, it's trading at 45. I issued 833, so that's what X thousand shares at the current price we issued yesterday, which is, all ties out, right? So that's this journal entry, basically, where we have no goodwill and no excess bargain purchase. Was anybody able to get the one with goodwill when we had 1.2 billion? What was the goodwill amount? 367 million. How did you guys get it? So you have $1.2 billion, and what was the fair value of the net assets? 833. And you get 367, right? So that's basically it, no? It's not that. Are you guys getting intimidated by the additional 3 zeros that are involved? No, I just don't write the zeros out. I just take them out. It's big numbers, yeah. Okay. So an excess bargain purchase, you could kind of see right away what was the excess bargain purchase. How much are we underpaying compared to fair value? $233 million? Yeah, it's just 833 less than 600 million. That's basically how much we're underpaying in the situation. No? So, and it's important to understand the journal entry format so that you could actually, put that in so you understand which accounts are debit and credit, because now we're going to start looking into the situation where we're not going to dissolve the subsidiary. So if we don't dissolve the subsidiary, we go through the same process. But since we don't dissolve the subsidiary, right, and if you look at the publisher slides, what we just did is equivalent to what the publisher is doing here in terms of just, basically dissolving the subsidiary, getting rid of it by, basically it doesn't exist, I take its assets, I issue my part of the financing, it's gone. Now, what happens when you don't dissolve the subsidiary? There's actually a table in these slides. So this is a good table to go through first. Now you sort of understand, like, there's a really drastic difference between dissolving a subsidiary and not dissolving a subsidiary, right? If you're talking about dissolution, there's a set of stuff that's going to happen, right? Statutory mergers through asset acquisition, and then there's dissolves and then goes out of business. That's the situation. The accounting is going to be done in a really specific way, right? Now, if you have a consolidation through capital stock acquisition, and the original company, the acquiree, remains in existence as a legal corporation and is now a subsidiary of the acquiring company. That's the second study we're going to look at right now. So we just got through the dissolution. Like, if they're talking about dissolution, I want you guys to understand, now you know what that is. That's just one big journal entry. Company's gone, you did a little financing, you did a little debiting on your balance sheet, see you later, done. Now, if you are going to keep this company around, right, that's the case study of Berkshire Hathaway and Geico. Company comes in, not involved with re-strategizing, just wants to own the asset and calls it its subsidiary, even though it owns the whole thing. The books of Geico keep going, the books of Berkshire Hathaway keep going, And Berkshire Hathaway wants to call Geico an investment. An investment. So what does that investment look like? This is when you want to start looking on page 57, and you start looking in this account, investment into subsidiary. I have it up here. Investment in small port. Because now, instead of like how did I look into this, for example, what did we say? Microsoft acquired Apple. I sort of looked at Apple and I said, you know what, Apple, you know what I'm going to do with you? It's probably Bill Gates' like biggest dream. I just dissolved you, right? But I didn't, but the idea is you don't want to do it. Some companies, they don't want to do that. So they're like, well, I don't want to dissolve that. I want to keep it and I'm going to account for it as an investment. So all the chapter 1 work that we did, right, last week, we're pretty familiar with this account, investment in small port, investment. We know what that is. It is an account that basically maintains a relationship with another company where you own a percentage. All I'm saying now is that I own 100%. That's all I'm saying. Now we go from the 30 to 100, but I'm still going to say it's an investment, right? And what am I going to do with this investment? Essentially, the same thing we did in chapter 1, where I'm going to accrue the earnings of the investee, receive possibly dividends, defer inventory, unrealized inventory, record amortization of the excess fair value of assets, like the amortization of patents and things like that. I'm going to just continue to do that as if it's equity method, because I'm like, I have this investment. I got to do this. Like, I got to maintain it. But what the consolidation is all about, and what I want to start getting into from a very technical perspective, is the elimination of intercompany transactions at year end to make it clear. If you really, start looking in terms of clarity, the process that we're going to go through. For example, Geico and Berkshire Hathaway. If you look in the Berkshire Hathaway financials, you won't see a trace of Geico. That's just not that's not like their style, is to show things like Geico, because Geico for them is just like a blip on their radar. And they don't want their financials to be around that specific blip. They're an investment complex. They want to show their assets and liabilities and income and loss in accordance with GAAP. They're not interested in telling you about every little single thing that happened with a little company they own somewhere. But they do have to have everything that happened at Geico be transferred to those financials. But everything is going to be sort of disguised in the totals of everything that's going on. So how do you do that? You basically eliminate this investment in small port. You eliminate the equity of the subsidiary. In other words, small port or whatever, Geico, continues to exist on its own, which means that it continues to have its own equity. If you look on just the equity piece here, you continue to exist, you continue to have equity, but at year end, when I bring these numbers over, for example, and kind of consolidate, does the subsidiary have any equity? No, it doesn't have equity, because when we acquired it in the past, we acquired all of its equity. That's what the acquisition means, is I acquired your equity. So you don't have any equity. So I got to eliminate this equity. But look at this sort of the struggle, the scenario that we're dealing with. Geico must maintain its own books. It doesn't care about Berkshire Hathaway. They're like, we have books, we're going to maintain them. So they'll continue living as if nothing happened. Berkshire Hathaway is just interested in getting this thing on their books without any of the detail. So they're going to take the avenues like, oh, it's just an investment, and we'll just maintain the investment account. If something happens, we'll just bucket it in the investment account. That way, everybody's happy. Everybody's happy. But at the end of the year, we can't just take these two common stocks and put it together, because the other one doesn't exist. So we got to go back. We got to go back and eliminate the equity from the initial purchase transaction and say, listen, remember when we first purchased you? We paid X dollars, right? And what happens, for example, when you pay X dollars for a company? It's called investment into, and you eliminate their equity. So that's what the stock account is. So if you look in terms of S, if you find S in the book, there's 5 types of consolidation journal entries. The 2 that I want to go over that are most interesting, the most exciting ones, are A and S. So S is for equity, and A is for assets. And I'll tell you what the shortcut is, guys. The shortcut is for S. It's the elimination of the book value of the subsidiary. So if the book value of the subsidiary is $500,000, right? What do I eliminate? I eliminate that equity, $500,000, and where do I place it on my balance sheet if I'm the parent company? What does the subsidiary equity mean? Assets minus liabilities, right? Keeps coming back to that, doesn't it? It's not going to stop for a while if you stay in accounting. So, right? So assets. So we have assets minus liabilities, equity, right? So what does that mean in terms of the investor? If I pay your net book value, what happens? I got your assets at book value. So that's the first piece. If I paid for your assets at book value, I got your assets at book value. So that's the standard equity elimination, is first to eliminate the equity and eliminate the investment to the degree that the investment is of book value. The A journal entry is the elimination of the markup of assets from book value to fair value and the equivalent amount in the investment account. That's A and S. A and S are in charge of what? Who can tell me the point? I would really love to hear this. Yeah, what's the point of A and S? Did you guys hear what he said? He's saying that basically the purpose is to bring over the assets together. First of all, for assets, you just bring them together. But it's also to eliminate the intercompany account, like the investment account, eliminate it, and the equity account to eliminate it. Because the consolidated financials are not going to have this account, investment into small port, and the consolidated financials are not going to have the equity of the subsidiary. Right? Subsidiary equity doesn't exist. But what's this relationship, intimate relationship between investment in small port and equity of small port? In a way, those two are related, because when the investment in small port is small port. What is small port? It's equity plus the excess of fair value over equity, right? What's investment into small port? Is the equity plus the markup of the assets, the fair value of the assets. So this is the process that we're dealing with here. So what I want to do is this is kind of what we're doing here. What we're doing here is we're bringing this information together, right, so that we can report it in the realm of a total entity, and then we have to eliminate certain accounts. So for example, say this big net and small port, say big net bought small port for $500,000, and that was small port's book value. What would be the elimination entry at the year end? If you're big net, what would be the investment into small port if you paid $500,000? $500,000, right? When you make a purchase, you debit investment into, right? Right? And now That was the book value of Smallport. So 500,000 is in your investment account, and 500,000 is in Smallport's equity account. So how do you eliminate both of those at year end? Exactly. You debit the equity, you debit the equity, you credit the investment. Yes. So you basically do the opposite of what's currently on the existent, right? So if you have a positive investment, then you got to credit. If you have a positive equity, then you must debit. You just go against what's going on right now to eliminate it. So when you look at these journal entries, in a way, you're just doing the opposite of what was going on before there, in a way, to eliminate these accounts. This is basically the goal of the consolidation worksheet that we're trying to work with. So I just want to go over the objectives of this goal here. Is we want to remove the subsidiary's equity account balances. We want to remove the investment in sub balance. Allocate the sub's fair value, including any excess of cost over book value, to identifiable assets or goodwill. Combine all account balances and extend into the consolidated total column. Subtract consolidated expenses from revenues to arrive at net income. So in a way, you know how if the solution took place, all we did was transfer the fair values of the acquiree to the balance sheet of the acquirer. If we don't do a dissolution upon acquisition, we don't really mark up the assets of the acquirer. We keep the assets and the investment into account, right? If the dissolution of Apple doesn't take place and Microsoft acquires Apple, is it going to mark up its software? Say I got 800 million more software from Apple. Am I going to debit the software account? No. I'm going to call it investment into Apple. Because I bought Apple, I didn't dissolve it. I'm going to call the whole thing, it's Apple, investment into Apple. But at year end, I got to mark up the assets to their fair value. So what am I going to do? This was, for example, the investment into Apple that I booked initially. And then what I'm going to do is I'm going to translate that into the markup of actual individual assets. I'm going to mark up my software to the degree that it is valued, a fair value above book value. I'm going to mark up my software, and so is all the other assets. And I'm going to eliminate this investment account to the degree that the fair value exceeds book value. That's one piece of the elimination. The other piece of the elimination is I'm going to eliminate the investment in Apple to the degree that I bought Apple's book value. That's the other piece of the elimination. Between these two pieces, what's book value plus the excess of fair value over book value? That's the payment. That's the total payment. That's the purchase price, always. Right? So that's the payment. So I eliminated the whole payment in two pieces. Book value plus fair value over book value. Done. Investment account is zero. Right? But what is the other piece when I eliminate the investment account by eliminating the book value of the subsidiary? What can I also eliminate in the same time now? Thank you. So you can eliminate the acquirees, the subsidiary Apple. You can eliminate their equity because you eliminated the book value of your investment, which 100% would have to equal the equity of the subsidiary, their assets minus liabilities. And this is this elimination right here, because if you look, the equity of this guy is just hanging out here, and I'm going to go ahead and debit it all. I'm debiting it all, and it's all going to tie up to this number here, which is the 600 in the situation. If you look in the book, it's the 600 and the 600 in the situation. And it ties out perfectly between eliminating the equity accounts and eliminating the investment net book value. And then the journal entry for the assets is marking up all the assets to fair value versus crediting the investment account by that amount. And this could have a goodwill aspect and also liabilities. I want you guys to sort of jump into this. I'm really going over like really basic scenario right now, but honestly, like in the book you'll see also have goodwill, liabilities. In the next chapter, also adding inventory, amortization, all sorts of different things in there that these things get bigger and bigger. So you want to start looking through how the worksheet works and figure out a way to work with it. Any questions on this, guys? Yeah. Homework? Yeah. Yeah, they have full sets of financials like that. Yeah. Full sets of financials like that. So we have about 8 minutes here. So So this is what I would do in order to study for this. I would really work with first, guys, with A and S, then work with the other 3 types of journal entries to figure out what's going on here. And sort of to get your bearings, I would tie out the right with the left. And just notice how this balances out in the A journal entry level. And with the S, notice how this 600 equals this 600. I think this one is really easy to see. You're just saying, listen, I'm crediting 600 with the investment, I'm debiting 600 out of the equity. So you see pretty clearly the equity, you wipe it out. And I think with this one, you see pretty clear, like, oh, I got to get rid of the rest of my investment account, so I'm going to credit that. And where, if you credit your investment account, what would you have to debit? The assets. The assets. The markup of the assets that you're getting. So if you're acquiring Apple and you've been keeping it as investment into Apple, and then you're going to be like, forget that, it's not investment into Apple, it's software, it's contracts, and it's current assets. So how is that going to be reflected on your balance sheet? Debit. So you actually have software now on your accounts. Because at the end of the day, you're not going to carry it as investment. Because it's going to be invisible. It's going to be invisible. So, technical accounting, huh? Anybody here planning to work in audit? Yeah. See, sometimes in audit they'll have a full week they'll just teach you technical accounting, 9 to 5. So this is an hour, guys. It's nothing. Sitting here like you guys are going to death row or something. Imagine 9 to 5 for 2 weeks straight. FX derivatives, technical FASB research. Come on, this is not. But this is basically the idea. This is basically the idea that we're going to go through. And I think it's really good actually to know in terms of your audit career and other things and what you're studying for is really good. This technical piece I think is the most technical in the accounting major. From my personal experience. But, for you to jump into it and understand it for the CPA exam, it's much better to do it now than later, because later, and it's right, to be honest with you, I used to work at EY, there was very, very small percentage of people who were year 3 or 4 or later who could pass the CPA exam. Many people, I think about 90% of those people would fail the exam consistently, mostly because they couldn't master these type of technical materials, because when you're working a lot, you just simply don't have the time to master something like this. So most kids who were in the firms would pass the exam like that, like first years. That's when I did it, before you get busy, But the 4th and 5th years could be thinking, oh, fail. Because it's not because you're stupid, it's because you just don't have a year to study when you're working full time. So those people, you just couldn't do it. So what I'm saying is that yes, it is technical, it is sort of in that realm, which is what I'm good at, but you got it better to study it now than later. How much do they give you as a bonus if you pass in the first year? Free getaway. There you go. Pass the exam. You can go on vacation. So the idea is, please guys, study the journal entries.